Hey guys, what's going on? In this video, I want to talk about margin and give you every single thing that I know about margin in this one video. And I specifically want to talk about the appropriate use of margin, what the research says about margin, and how I'm using margin in my two different portfolios. As you can see on the screen right now, I want to talk about using 110% margin. Now, this is specifically a research report that I remember reading from Yale, but I can't find it online. I found something very similar though, supporting what actual professionals, PhDs, and financiers say about margin use. Now, there is a lot of kind of hypocrisy. There's a lot of debate about how to actually use margin properly. So I'm going to give you my personal opinion and what I've actually been doing, because for me, it's been working. And for many of my clients, we also use margin. As soon as they're able to trade consistently and profitably, using margin is a no-brainer. Okay, so right now I have researched, or I put in 110% margin Yale reports. Okay, this is one of the first articles that comes up. It's by some PhDs, right? It's a .org research paper, and the abstract here is by employing leverage to gain more exposure to stocks when young. Okay, this is a relative term, okay, because even if you're 50 years old but you're looking to retire at 70, that is young because you have a 20-year horizon. So for me, what young means is you still have at least 10 to 20 more years of investing, which pretty much everyone watching does. Even if you're in your older age and you're already retired, you still probably have a decent amount of time to deploy margin strategies, at least 10%. And later on in this video, I'm actually going to talk about how I use 200 to 300%. Again, it sounds crazy, but you really need to listen to how I'm doing it, because I'm not going about it blindly. I'm not using it in a risky way. In fact, I've actually never had a margin call. So that's one of the risks with margin trading, is if it goes against you, you have a margin call and you end up losing and being forced to sell your assets. I need you to understand, part of my job, if you will, as a coach is to actually preserve wealth. Now, I don't have many high net worth clients. I don't have too many millionaires. Actually, most of my students are starting with $10,000 to $25,000. But still, wealth preservation and understanding how to properly trade without losing money is one of the most important things that I focus on, because it doesn't really matter where you start. Even if you start with a few $1,000s, my goal, and what I think your goal and the point of you even watching this, is you're going to be trading long term and you're going to get to 5, 6, and 7 and potentially 8 figures in your portfolio over time. And you need to first understand how to manage small amounts of money to then be able to manage medium and large amounts of money. I started very small. I'm very happy because I made all these mistakes in the beginning. They're pretty much unavoidable. Even though I had mentors, I still made mistakes. So it's really important to think about wealth preservation. When I was at Goldman Sachs, all these, 100 millionaires, these people have invented things. They're CEOs. They've made big changes in the world. They're actually getting a roughly 3 to 4% return per year, which is super low. You might ask yourself, why are these people Goldman Sachs clients? Well, that's because for them, they're really looking to preserve their wealth and just match inflation, because they're so rich already. They're not really looking for growth. Now, I understand that's none of the people watching my videos right now. All of you guys, I already know, because I've coached 3,000 people, you have, a few $1,000s, maybe you have 5 figures, and then some people have 6 figures. That's completely okay. That's actually who I focus on, because that's just the majority of people looking for help. For me, here's what the research says, okay? If you're young or you have a horizon of 10 to 20 years, individuals can achieve better diversification across time using stock data going back to 1871, okay? This research report is, dating back a long time. We show that buying stock on margin when young combined with more conservative investments when older stochastically dominates standard investment strategies. This is literally a research report done by professionals saying that margin makes a lot of sense. And this data is going back a very long time. Ever since I read this, I was probably working at Goldman Sachs at the time. This was probably 2016, so this was 7 years ago. I've started to utilize margin, and it has been an absolute game changer. And again, in 7 years, I went through, COVID. I went through, quite a bit of crashes, and I've had a lot of Tesla in my portfolio. I haven't even followed the best risk management practices. However, I've never had a margin call. That's very important because a margin call is devastating. But if you really understand by the end of this video, you shouldn't really have a margin call, because something that you can do, say you sell some puts, say you sell puts that are a 10 delta, super out of the money, and you use, let's say, $10,000 of margin, or if you're using SPY, let's say you use $40,000 of margin, even if that's a lot of money for you, okay? If it goes down, what you can do is you can roll lower, okay? Say you have a 100 strike, okay? You can roll down to 95, 93, 91, and you can do that week after week after week, rolling down. And that's basically my strategy to never experience an assignment that is devastating, okay? And I've done this, again, for 7 years. I can't even think of a situation where I would have a margin call or where I would have a devastating outcome. I mean, the chances are truly less than 1% if you're doing this correctly, okay? So to continue this article, and by the way, we have a Goldman Sachs article that I want to look at as well, because specifically we've been, thinking that at some point in 2023, we would get a pullback. Even Goldman Sachs has been really confused about this. But anyways, both traditional life cycle investments and 100% stock investments, the expected retirement wealth is 90% higher compared to life cycle funds and 19% higher compared to 100% stock investments. The expected gain would allow workers to retire almost 6 years earlier or extend their standard of living during retirement by 27 years. Okay, this is the most insane thing. We have all these stock videos on YouTube. We have all these get rich quick and these gurus talking. But let's actually talk about the research, actual PhDs, people that are studying this stuff. Now, I get it. It's boring to read this stuff. I do read this stuff in my free time. This is real research. This is what I would be paying attention to. Like, truly, if someone is saying, okay, the research says that you can retire 6 years earlier, this is a fact, versus, you can retire tomorrow with some brand new golden strategy. I've never really seen that. It's like winning the lottery. But this right here, shedding 6 years or getting closer to retirement by 6 years, that's a hell of a difference. Imagine instead of being 50 and you're retiring at 44. Or instead of 60, it's 54, right? It's a huge, huge difference. So when I was reading this research report, they were talking about a 20-year-old might be 90-10 in stocks versus bonds, okay? This is a little bit interesting because if you look at research reports, if you look at what financial advisors talk about, they always suggest bonds, okay? And I know some people that get into their later years that have bigger portfolios. Even Vanguard, Jack Bogle, before he passed away, he was talking about, taking your age, taking 100 minus your age. So let's say you're 50. Take 100 minus your age, which is 50, that's 50. So you do 50-50, stocks and bonds. Me personally, there was a research report that I read about turning stocks into bonds, okay? I studied this very, very well. In fact, that's why I use covered calls. You might not understand this fully, but when you're doing a covered call that's in the money or at the money and you're collecting a lot of premium, is specifically in the money. I'll show you an example, actually. Let me just quickly show you an example of why I think bonds are completely useless, in that when you use margin, you should just go 100% options. Again, it sounds risky, but it's really not, okay? So actually I have VTV in my portfolio. In my Discord community, I said that I do expect a little bit of a pullback in the market any day. And when I specifically looked at growth versus value, okay, so growth companies, obviously, we know those are the Amazons, the Microsofts of the world. They are fairly risky right now because they're at a 52-week high. Now, don't get me wrong, value stocks are also at a 52-week high, but if you look at the volatility, it's very low. And the next crash that we get, or the next pullback we get, which I'm expecting anytime now, I don't know, in September, in October, or later in 2023, when that happens, right, if you're watching this in the future, it's still relevant for the future. When that happens, value stocks are going to outperform growth stocks. And that's because value stocks have more support to them. They're not valued as highly. Their price to sales ratio is not as high. Their price to earnings ratio is not high. If we actually look at the holdings here, the holdings in VTV are Berkshire, United Health, ExxonMobil, Johnson & Johnson, JP Morgan, Procter & Gamble, Chevron. Okay, these companies have a lot of stability to them because they're huge mega cap companies. And what value means is it's a relative metric, okay? Growth means that, Amazon, you take a look at the price to earnings ratio, last time I checked, it was like 68. But if you take a look at, one of these companies like Chevron, specifically, if I take a look at Chevron right now, you'll see that, they have a dividend and the price earnings ratio is 10. Just so you know, the S&P 500 average is like 18. So this right here, the price earnings ratio is below the average of the S&P 500, which is already safe. And that's why I decided to go into VTV. But specifically talking about bonds, in VTV, what I did was I did a covered call. Okay, so as you can see, I just recently did this. I opened up this position on August 9th. It's August 15th now. Again, it doesn't really matter. What matters is the logic and the thought process that I'm using. You can watch this in 5 years and you still use the same thought process. But essentially, I sold a covered call, which was only 9 days out, collecting $1,200. I mean, that's $1,200 in 9 days. Now, for most people, if you can make $1,200 like basically a week, you're already really on the right track to pretty much retiring. I mean, it's not the most money in the world, but hey, if you can make $4,800 a month, you can certainly do a lot with that money, okay? All right, so what I did was I bought several hundred shares. I bought 1,200 shares. Yeah, I dumped a whole bunch of money in. I dumped $174,000, and that's because I expect the market to pull back. And what I'm trying to do with this position is making it similar to a fixed income instrument. Okay, a fixed income instrument is basically like a bond. A bond is something that has no risk, right? Like a treasury bill, 30-year note. These assets just pay you, kind of like a CD. Okay, you go to the bank, you just drop your money, get paid a guaranteed income from the government. Okay, here I'm trying to do something very similar, but with stocks. Okay, I'm trying to get a little bit higher of a return, but have it still mirror something extremely safe, right? So value stocks are extremely safe. I bought 1,200 shares and then I sold a 146 covered call. Okay, so I did 12 contracts here, and as you can see, the market went down by $270, but my options here made $624. And this is truly why I think bonds are useless. Okay, you should have, again, going back to the formula, 100 minus your age. And I'm gonna tell you this is the basic formula. I'm gonna tell you my opinion after. The basic formula is 100 minus your age, and the rest are bonds. But I replace bonds with super safe covered calls, okay? Probably never even heard this on YouTube, because this is something that most people don't understand, even if they're finance influencers. Because they're influencers, they don't have a financial education or actual work experience in the financial advisory world, okay? I wasn't a financial advisor, I was actually a financial analyst, and I spent time at Goldman Sachs. Again, I didn't have a full-time job there. Okay, I have no interest in working in investment banking or full-time. As soon as I graduated college, I already had all of the financial education that I needed. I had tons of internships. I had tons of jobs, tons of mentors. I didn't want a finance job. That's why I actually took a consulting job to learn more about technology, because I was a software analyst. So after that, I did not want to work in finance anymore. It is not a fun job. Plus, when you work in finance, you're not able to trade. And that was one of the biggest issues for me, that one of the biggest reasons I didn't take a job was because I wanted to trade and not be restricted, and many companies restrict you. So again, 100 minus your age, that's what you should have in the safest covered calls. Now, I still love covered calls in general. You can actually have, if you have $100,000, you could put all $100,000 into covered calls. That's not a problem. But what I'm saying is, if you want to have bonds, if you want to be safer, okay, what you can do is do covered calls on the safest stocks possible in the money. Okay, now there's some nuances there. I went a little bit out of the money. I had my average cost here 145.56, and then I sold a 146 covered call. So I picked the soonest out of the money option. Now I did that because this is really low risk, but had this been a little bit higher risk fund or a higher risk ETF or a higher risk stock, then I would have went a little bit more in the money. So that is what the research says. 100 minus your age. Jack Bogle talked about this. Vanguard, trillions of dollars asset manager, they have research on this. Me personally, I have 100% of my net worth. I walk the talk. I mean, heck, I could open my bank account, but there's some security issues there. I literally have nothing in my bank accounts. I literally have no money. Okay, I'm cash poor. I put everything into options. Okay, I have 2 portfolios and everything is there. That's 100% of my worth, because I really trust the process. I mean, I've been doing it for a decade, and my process is basically, instead of 100 minus your age, I actually go on margin, okay? So tracking back to the margin topic, I'm using margin because I can't find any research currently, but I read tons of research before, and I read lots of internal research, okay? When I was working inside Wall Street, I was reading internal research from hedge funds, which are not shared to the public. Okay, and what I learned was, again, they say 110%. I actually take it to the next level. I actually invest a lot more than 10% in margin. I'm going 40% on margin. In fact, if we look at my portfolio right now, and Robinhood doesn't actually accurately track this, but if I go to investing, it says I'm fully invested in stocks and options, but if we actually take my notional value is basically like how much I have in exposure with options in total, right? So for example, I have 235 put option on Tesla. I finally jumped into Tesla after it's gone down a bit. Looking at the 235 put, I sold 15 contracts, which is that's roughly, right, you would take 10 times 235, that's 235,000, plus another like 112 and a half, so that's going to be 300 and basically $352,500 in notional value, okay? So I have about $350K that I've sold, okay? So this is money that I don't really have. This is money that I'm using on margin. And in Tesla's example, it's a little bit riskier because it's really close to the money, but a majority of what I'm selling puts on is going to be those safer SPY and QQQ ETFs. I'm just trying to look in my portfolio where they are because they may have recently expired, because I have been doing some zero DTE trading. I know I'm probably teaching you so much in this video. Basically, zero DTE trading means 0 days to expiration. I've been doing that because I feel like the market is a little bit in a vulnerable, risky place. And because of that, I've been doing a little bit of shorter term trading, which is not really typical of me. Now, last thing I really want to cover is where the market's at and why I'm doing a little bit shorter term trading. And lastly, I'll just tie in how I would basically use margin, which I've already said in the beginning. It's by selling puts mainly, QQQ, SPY. If you have a smaller portfolio, you can still sell put options on just high quality companies, right? It could be the American Airlines that I've been recommending on this channel for 2 years now. I mean, I've been talking about American Airlines. Everyone's talking about the Rivian and the SoFi and the Palantir. I love Palantir too, and I've recommended at $7. But truly speaking, there's a lot of hype out there. There's a lot of interest out there. I know you guys are super excited for some of these stocks to 10, 50x. But truly speaking, American Airlines has been a bread and butter stock for me. It's been absolute money. It's been just printing cash because, if I take a look at the chart, let me just show you what American Airlines looks like and why I'm comfortable using margin on a stock like this. If I'm going to use margin, I'm going to pick a stock that's stable. I'm going to pick a stock that has tremendous support, and I want to also sell options that are very low delta. So, I talked about not getting a margin call, and the way you do that is by you go for a 10 delta, you go for a 12 delta, you pick an ETF that has tremendously high quality companies inside there, right? The big mega cap companies like SPY, those are all components, right? The 500 largest companies in the world. And even if the market crashes, you roll down. So I'll show you an example of that in just a moment. But American Airlines, right? 1585. This stock over the past 5 years, I mean, I wasn't trading it in 2018, but as soon as it fell to these levels in 2020, which is basically when I was starting this YouTube channel, from the very beginning, I said I love American Airlines. This is one of the best companies I've seen because it's American Airlines. Like, it's America, right? It's a pretty good bet to bet on America financially, okay, financially speaking. And then the airlines are an essential part of the economy. So, this was COVID, and COVID crushed airlines because people can't travel, but, people are traveling more, and they really can't go bankrupt because they're going to get saved by the US government. And yeah, American Airlines, the only downside is they have tons of debt. The debt is very high, okay? But that's besides the point. I think this company is going to get bailed out in worst case scenario. And then airlines also historically have always had a lot of debt. It's not easy running an airline business because the airplanes are super expensive and there's lots of other costs associated with being an airline business. I mean, the pilots are pretty expensive, and there's also maintenance and repair, and there's also tons of insurance, and there's also tons of debt and loan interest payments that they have to make. But taking a look at American Airlines, I mean, just one of the most stable stocks. I mean, truly speaking, you guys are chasing those SoFis, you guys that are watching those Palantir videos. I try to keep this channel away from recommending specific stocks because I've done that in the past. I've been right. But as soon as the stock pulls back, I get a bunch of comments saying how I was wrong. But look, on a long-term basis, I've been one of the most successful investors, even though I'm investing in sometimes companies that are fairly expensive. I've caught NEO at $4, and I've kept recommending it since $4, okay? And I've recommended it, yes, at higher points than it is now. And people that started watching me are upset because they missed the $4 that I've recommended. But from the very beginning, from my results over a long period of time, it's been incredible. It's been incredible. But from any short period of time, sure, like I've had my mistakes. I'm only human. Like I don't always know the exact right price to buy everything. I just don't, and nobody does. And if they say they do, I mean, it's a lie. Like I don't know. And I worked in this industry for a long time, and the people that are the best traders, they don't know. And their bosses, they also don't know. This is a completely random game. However, there are nuances and there's strategies that just work, and that's the research of it, okay? So I always try to understand this game, but there's truly, you can't really fully understand it because there's a random walk hypothesis, which basically means that the stock market is pretty random, okay? But looking at American Airlines, this is anything but random. I mean, this is one of the most predictable companies. I just can't speak enough good things. I've been just destroying it with this company, and I have a $10 return right now, but I do this every single week or every 2 weeks, right? Because I've been getting a little bit lazier lately. I don't want to trade weekly because if I can make the same money in 2 weeks, then why not? And I've been telling my students like, hey, relax, we're making money. We don't need to over trade here, okay? Because way too many people they join the Discord community, which, again, as always, first link in the description. You can watch a free training, book a call, and learn about the pricing and pick a package that works for you. And that way you don't get scammed because there's too many scam comments in my description, in everyone's description. I can't control that, okay? So please be careful of scammers. I'm not going to personally reach out to you. It's only the first link by getting on a live call is how I actually sell my Discord. That's it, nothing else. And basically, a lot of people, they come in and they have this notion of being an active trader, but that's really not what I'm teaching on the channel. I'm really teaching the passive income component. And, believe it or not, but outside of making these videos, which, it's only like maybe 30 minutes every couple of days. I'm trying to upload maybe 3 or 4 times a week. Aside from coaching, my group coaching, I'm really not trading outside of that. Everything I do is on camera. Everything I buy and sell is posted. I really don't want to make this a full-time job because it shouldn't be. Investing should be investing, making your money work for you, not working and chasing your money and like paying really close attention to it, because that kind of defeats the purpose of investing. Just go get another job, right? American Airlines is the exact example of I just sell options 1 to 2 weeks out. I pick a pretty low delta. So actually, there's a difference. Sometimes I look at delta, but with American Airlines, I'm looking at the support. There's tremendous support at 1550. In fact, if I go over my history, and this is how well I know American Airlines. It went up to 1835 recently, okay? And I really started to not like it. I mean, I love the company, but I don't like it at 1835. So if you look at my history, I sold puts 15, 16, 15 and a half, 15 and a half, 15 and a half, 15, 13 and a half, 13.5. You don't see me chasing it to 18. You don't see me chasing it to 17. Unfortunately, I had to back off of American Airlines for a whole month. I mean, look, I sold June 26th and I didn't touch it again until July 24th. I had to avoid the stock for, 28 days. And that's because I think that it was getting very expensive. So look, if I continue to look at my history of American Airlines, I mean, it's just 13, 14 and a half, 13, 14 and a half, 13. I'm just running the wheel strategy, which is like my very favorite strategy that I can do in American Airlines. And as you can see, I continue to go back into 2022. I'm still selling 13 puts, 13 and a half, 12 and a half covered calls. I'm just running the wheel strategy around the 13 level, 14 level, 13. I mean, look, I'm literally going back and showing you guys my history. I mean, just transparently, I don't want to just talk the talk. I'm, just take a look at my screen. We have July 18, July 11. You can still see that it's just the same strikes, and it's just collection of premium, you know, $300, $55. You know, I had shares here, and I actually sold the shares at $15.25. I literally sold the shares here at $15.25. So you can see how I've been selling puts, covered calls, and then finally getting into a 15.27 selling the shares. I mean, I've been perfect on this. I'm not trying to brag here. Again, I'm not perfect. I don't have a 3x return in a year. Some people claim they have that. I don't believe them. Okay, but you know, I'm having a good return. It's not enormous, but it's a really good, consistent return. Again, that's all I really care about is consistency. You can see here how looks like I had a sell call at 19.5, 20, 17. So you know, American Airlines was hovering a little bit higher in 2021. You can see how I'm still going back now. 2020, guys, 2020. I'm going back 3 years, showing you. Again, I'm not just telling you, showing you. 2020. Maybe I'll even go. I don't know, how far back does this go? You can still see I'm still running the wheel. 3 years of running the wheel. Still scrolling here. 2020, July of 2020, June of 2020. I'm gonna scroll to the very bottom. Trading it since 2018, okay, in this portfolio, right? I've had, you know, I've been moving portfolios, but in Robinhood since 2018, I've been trading the same stock, okay? Now, you know, talking a little bit more about how to use margin. Specifically, you always want to use margin, but you want to be very careful when the outlook is kind of grim, okay? So this is a research report about 2023, and now that we're more than half done 2023, I want to see if Goldman Sachs was spot on or not, because they released this research report in late 2022, and this is some of the smartest, best economic analysts in the world, okay? And this is what he had to say about the market going into 2023, which, by the way, I have a lot of agreement here, and I still agree. So unfortunately, he's been very wrong so far, and I haven't brought up the fact that I think we're going to fall in January, but now I'm bringing up the fact that in the second half, or really in the fourth quarter of 2023, I'm expecting a pullback. Okay, so the longer we are in a bull cycle, in a bull market, you know, the more predictable or the more certain an eventual pullback is going to happen, because the market has cycles. Okay, so you know, the article says the key macroeconomic question of the year has been whether inflationary overheating can be reversed without a recession. I don't think so. I think in most cases we're going to have some sort of recession, even if it's a short-term one, okay? And we've already seen that. We've already seen housing prices come down a significant amount. Inventory out there is pretty low. People don't want to sell their house. They're not getting the price that they want. We also see BlackRock buying up lots of property, which is truly scary. I don't know if you guys know this, but you have companies like BlackRock, which basically rule the world, and they have trillions of dollars of assets. They're buying up all the inventory, and they're turning this into a renter's market. So, you know, people cannot afford to buy. There's not enough inventory out there, so everyone is pretty much being forced into renting, and that's a way of controlling the American people, right? I don't want to say that buying a house is great, but at least having the option to buy a house is great, all right? If you don't even have the option to own property, that's bad. Now, my personal belief is I don't want to own any property, and I don't own anything, and I don't have any plans to, because I think that option trading consistently and safely is better than real estate, and it's less management. I don't want to have anyone calling me and texting me just because I love my freedom. I love being having that freedom, okay? So again, this best analyst in the world was saying that the first step in keeping the adjustment process on track is ensuring that GDP growth remains below potential. The fiscal tightening that helps it slow the economy this year has mostly run its course, but the large tightening in financial conditions engineered by the Fed should keep GDP growth near 1% in 2023. So yeah, the United States is growing, but very, very little, and this is a very fragile number because 1% is very close to 0%. So again, we can get a shift, and the whole point of this, are we going to have a soft landing or a hard landing? Okay, I'm expecting a soft one, okay, because there's a lot of wealthy people in the market. Sure, it seems to be some manipulation going on. There does seem to be by the Federal Reserve. There seems to be, you know what I mean? The wealthier people are doing quite well in the stock market. They tend to have more information from my belief. We've seen that with some political candidates, you know, being able to predict the stock market, and they're not stock market geniuses. They just have, you know, information not accessible to the public. You know, for many reasons, though, a lot of people are invested in the stock market. So I don't think it's going to have a hard landing. I think we're going to have a softer landing. So, you know, going into more of this research, I'm going to kind of glance over this. But basically, the research article talks about, you know, wage growth and real GDP, which both really important economic indicators. This is what economists look at, and this is what economists are trying to predict here. Because, you know, the labor market and the wage market has a lot to do with the stock market. But the way this ties into margin trading is, you know, and I tried to Google as much as I could, everyone should be using margin. I truly can't find the research that I used to read, and, you know, it's been a long time now, 7 years, so I believe I was reading research that was internal to the hedge fund that I was working for. But, you know, for me, I mentioned that I use up to 200% of my portfolio margin. Now, that's a different portfolio that I usually don't cover on this YouTube channel. I've mentioned it in the last video. But for me, if I were to give advice, obviously I'm not a financial advisor. I have tons of experience. I'm wealthy, and I've been doing this basically as my full-time job, if you will. My basic advice would be to use margin once you are comfortable in getting consistent returns. Start with 10% and continue to increase as you feel necessary. For me, I feel it necessary to use 200%. What I'm doing, though, is I'm selling very low delta options on some of the highest quality companies. So if you have any questions, feel free to drop a comment. I will try to respond with a follow-up video on this into the future. Leave a like on the video, subscribe, have notification bell on, because I try to make the highest quality videos. I'm not here to upload lots of quantity. I'm here to upload lots of quality to teach you how to be the best option trader, the most stable investor in the world, ideally, so you can retire and live a life of freedom. So thanks so much, and I'll see you guys in the next video.